Passive income. Nothing's better than sitting back or living your life and receiving this nice little paycheck every single month or quarter for doing absolutely nothing. Many dividend investors get to a point where the dividend they earn makes them more money per month than even their full-time job. Warren Buffett receives a dividend from just Apple alone at over $878 million per year. That's almost $2.5 million per day, over $100,000 per hour, and literally $27 per second from just a dividend. Now, most of us will never invest at that level, but to live off dividends is a very realistic goal. I'm going to show you what 10 years of investing into dividends and reinvesting those dividends could turn into, and how you could actually live off of this very, very easily, which is a little more than $2,500 per month. The total dividends alone was almost $100,000. I'm Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. I know most of you have been investing for a little while, but I do also have beginners on this video, and so I want to make sure and make everything as simple as possible for anybody. So let me very, very quickly go over the main bullet points of what a dividend actually is so that you can understand this a little bit better. And if you already know this info, maybe take a second and just comment down below what your favorite dividend stock or dividend ETF is and why. This will help out other people to be able to do more research to figure out which dividend stock or ETF might be the best bet. A dividend is a payment of a part of a company's profit to eligible stockholders, typically from a publicly traded company. Dividends are generally paid on a per-share basis. If you own 100 shares of the ABC Corporation, the 100 shares are the basis for your dividend distribution. Assume you bought ABC Corporation at $100 per share for a total investment of $10,000. Profits at the ABC Corporation were very high, so the board of directors agrees to pay its shareholders $10 per share annually in the form of a cash dividend. So as an owner of ABC Corporation for a year, your continued investment in ABC Corp results in $1,000 of dividends. So you had invested about $10,000, and now each year you're going to get a dividend from them at $1,000 per year. Remember too that if you ever just wanted to sell your shares, you'd also get that $10,000 back as long as the stock is still at the same price, or it could be worth more and you could sell that for a profit. So it's not like the original investment is gone, because sometimes people say something like, well, I'm putting in $10,000 and only getting $1,000. That's going to take me 10 years to recoup my investment. Technically, that's not necessarily true, because it's not like you're losing that $10,000 from the beginning. Now you can see on stock sheets or ETF info sheets what the dividend yield has been. This does not mean that it'll always be that way if you buy the stock or ETF, but it does give you data of what has happened in the past. This is why I like to look at least 10 years worth of data so that we can see what the dividend has been and we can generally have an idea. But I don't just like dividend stocks or ETFs that have had a dividend for 10 years. I like to gravitate towards ones that have actually increased their dividend every year for at least 10 years. I like to start with the list of dividend kings, which are all companies that have increased their dividends every single year for over 50 years, which makes them very reliable. I also like to use this tool on Seeking Alpha to check dividend growth whenever I look up a new dividend stock or ETF and when I do my research, so definitely check that one out soon. Now, dividend investing is easily the most fun and passive way to actually earn passive income. But before I show you some crazy numbers that you could actually attain, I want to introduce the sponsor of this video, Policy Genius. When we invest in dividend assets, we're trying to provide peace of mind to ourselves and our family later on in life. Policy Genius does that same thing in finding you the best insurance to keep you and your family safe. Policy Genius is your one-stop shop to find and buy the insurance you need at the right price. Just like stocks, the world of insurance is complicated. So with Policy Genius, you can easily compare quotes from America's top insurers in just a few clicks to find your lowest price. And what I like most about Policy Genius is that it gives you unbiased advice from a licensed expert support team. They have no incentive to recommend one insurer over another, so you can trust their guidance. They also have thousands of 5-star reviews on Google and Trustpilot from customers who found the best fit for their needs. With Policy Genius, you could find life insurance policies that start at just $292 per year for $1 million of coverage. Some options offer same-day approval and avoid unnecessary medical exams. Check out Policy Genius at policygenius.com/investing-simplified with my link down in the description below to save 50% or more. Now back to some dividends. So here are 3 likely scenarios for you and how much you could realistically make with dividend investing in 10 years. And then after that, I'm gonna end the video with a couple of cons to dividend investing just so that you get a full picture of what dividend investing is all about. Using the tool on marketbeat.com, I like to figure out a more full calculation on what could happen with dividends. So the first thing we're gonna do is go to marketbeat.com, go to this research tools, and look up the dividend calculator. What we need to know is a lot of these numbers here. And so let's start with at Seeking Alpha, go to the S&P 500, go to the dividend section and go to dividend growth. We can see down here for the 10 years that there's been some growth pretty consistently over the S&P 500. And you can see here the CAGR, or the compounded annual growth rate. And so on average, just doing the eye test here, we're looking at, I'll say 6% conservatively, that it's growing each year. When we go back to that dividend calculator, we can go ahead and put the annual dividend amount increase per year at 6%. The initial annual dividend yield, we'll just say right now at 1.46%. As far as share price appreciation, on average, the S&P 500 has gone up about 7 to 8%. Without dividends reinvested, so just the price appreciation was 7%. We're going to invest for 10 years. We're going to start at $10,000. Our annual contribution will be another $10,000, and the dividend tax rate will be at 15%. With that, we can see that our ending balance is going to be $168,000. The total return was over 52%. Our annual dividend is $2,233. And this is our total dividend payments over the 10 years. Now, if we go to more of a dividend style fund, like SCHD, we can look at here, if we go to the dividends and we figure out the dividend growth, we can see that on average, the CAGR here is closer to 11 or 12%. The ending yield was 3.49%. So let's switch that up here. So 3.49%. This one, we're gonna say 11%. The annual share price appreciation has been about 7% as well. We're gonna do it for 10 years invested. Everything else is gonna be the same. Our dividend tax rate, all of that. When we calculate this one, we can now see, first of all, this ending balance is similar to what we had before, but what's not similar is the annual dividend income. We have annual dividend income now of about $10,000, and the total dividend payments over the 10 years is $33,000. That's much different, and this is really, really nice because you're looking at this point, almost getting $1,000 per month of passive income. Now, if we look at one more, we're gonna look at Altria. Altria is one that a lot of people really, really like because it's such a high dividend. Really solid dividend growth for this company. The dividend yield last year was 9.52%, which is solid. The growth isn't as high as SCHD, but it is looking like it's a bit higher than the S&P 500. On average, it was closer to 7.5% for a while. Recently, closer to maybe 5%. So I'm gonna go in between 4 and 7, and we'll just call it 5% just to be conservative. 9.52%, this was 5%. And when we look at a single stock like Altria, it's tough because it can be much more volatile. Super high, super low, bringing it back up. So it's tough to figure out the actual price appreciation. When we look at the dividend calculator, let's go ahead and act as if the share price is going to stay the same. So for 10 years, the share price stays the same, doesn't go up, doesn't go down. We're just going to look at just the annual dividend increase. So after 10 years, we'd have a similar ending balance as the SCHD, but the annual dividend is insane. We're getting about $30,000 in dividends from this stock, which is a little more than $2,500 per month. The total dividends alone was almost $100,000. So it is very realistic that you could live off of dividends or at least be getting a nice solid paycheck, especially if you've been investing for a while. You do want to keep in mind that some of those ones that look very attractive, like Altria, will have a very nice dividend growth rate and has been sustainable for quite some time, but as you saw in that chart, it did drop in share price a bunch. So yes, the dividend rate is high, the dividend amount is high, but if you have to sell out of those shares and it's in a deficit, you're going to lose some money in that regard. That's why it's important to not just look at dividend yield, not just look at dividend growth, but also look at the company itself, the appreciation over time, and I like to look at data for at least 10 years to give me a good idea of what company or what ETF actually can do what it can do. And now, yes, up until this point, we've talked only positively about dividend investing, but there are some cons. During the financial meltdown in 2008 and 2009, almost all major banks either slashed or eliminated their dividend payouts. These companies were known for consistently stable dividend payouts each quarter for over 100 years in some cases. This seems so reliable, but they had to cut their dividends. In other words, dividends are not guaranteed and are subject to macroeconomic or company-specific risks. Another downside to dividend-paying stocks is that companies that pay dividends, or at least higher dividends, are not usually growth-style companies. There's some exceptions, but high-growth companies typically do not pay sizable amounts of dividends to their shareholders, even if they have significantly outperformed the vast majority of stocks over time. Growth companies spend much more money on research and development, capital expansion, retaining talented employees, and mergers and acquisitions. A lot of the earnings here are just being reinvested back in to stay above the competition because it's so fast-paced and you have to keep moving. So if you're looking for your portfolio to grow at a certain rate, you might want to hold more growth companies or growth ETFs alongside these dividend ones that are producing that income base. As far as how I believe that all should invest, I think we should all have the best of all worlds. So I hope you have at least one dividend ETF, one foundational ETF, and one growth ETF. To see exactly how I'd break that up in a perfect portfolio that's super simple, check this video out, and I'll see you on the next one.